In this week's update, uranium breaks out, growth stocks continue to outperform value, and the market is still not buying the inflation story. My name's Garry Davis, and as always, this is general advice in this video, and please remember to like and subscribe to the video. Okay, let's start with an overall market perspective. As you would be aware, I've been expecting some sort of mild weakness during August and September. So far, we haven't had really anything to speak of, just the odd day here and there. But with the second half of September coming up, it is traditionally one of the weaker periods of the year, the final 2 or 3 weeks. That doesn't provide any sort of guarantee that we will get a pullback in this period, but I certainly would just be a little bit more careful in terms of entries. If something's good, go ahead and buy it. Don't hold off just because it's September. And really, whatever happens in the next 2 to 3 weeks really should only be of concern to really short-term traders. If you're a day trader or you're typically in and out in a few days, then naturally some weakness is meaningful. But for everybody else, it's pretty much game on as usual. Pardon me. Now, the fundamental reasons why I believe the market will continue to rally, certainly at the index level, but even more so at selected individual stock levels. I think there's just so many stocks that have just got such a great future. So there's a number of fundamental reasons, but let me just touch on a couple of the main ones that are the real drivers of where money flows at the end of the day. Real interest rates, so that's nominal interest rates less inflation, are likely to remain negative. And, that's just a really strong environment for equities. Stimulus is still huge by any measure. Now, there's all sorts of talk about tapering stimulus, and I'm sure there'll be a degree of that happening, but stimulus is just so overwhelmingly massive that even if they cut it in half, it would still be significant. And that money is just sloshing around looking for a home. And then we look at the technical reasons, and there are many of these, but we can look at growth over value, and we look at these ratios every week. And growth is still outperforming value. There was a period there of about 6 months when the world started opening up again from COVID that value did outperform, but certainly growth has now reasserted itself since about May of this year. If we look at discretionary over staples, again, that shows you that the market is quite prepared to put money into the aggressive sectors of the market. It hasn't turned defensive. And one interesting thing happened on Friday night with the US indices all down. The worst performers were the defensives, utilities, real estate, healthcare. So, that was pretty incredible as well. And whilst technology fell, it actually did better. It fell less than some of the real defensive areas. So that just tells you about the mindset of the market. And of course, sector relativities. Where's the money flowing? And if you stay focused on the highest probability, strongest trends, then whatever's happening at the index level really doesn't matter a great deal. All right, American stocks, the S&P ended up down 1.7 for the week. Bit more than half of that was last night, or for Friday night, I should say. The inflation data is still coming through, pointing to the upside, but that was always the case. The Fed always said that we could see up to 2 years of rising inflation, and that they didn't care if it went above their 2% level because they believed it was only going to be transitory. So that data is still pointing higher, but very clearly, the aggressive sectors are still leading. So, that part of the market is just not concerned about it. There's no evidence of aggressive selling in those sectors. And of course, one of the big moves last week was the uranium, and the whole uranium sector all around the world has really finally taken off. I've been talking about it for nearly 3 years now, and it was just taking a frustrating amount of time to get going, but it certainly has picked up momentum in the last 2 weeks. And the uranium ETF in America was up 10% across last week. It's broken out. It looks tremendous, but there's still a long way to go over the next few years. US dollar was up mildly to 92.64. The yield was pretty much steady at 1.34. And again, that's an indicator of where the market thinks the inflation is going or not going, as the case may be. And the VIX has moved up from around 16.5 to about 20.5. So the market just a little bit more cautious, but nothing too much there really. So let's jump into some charts. There's the S&P. You can see it's just a beautiful uptrend. We've had a rolling correction, if you like, by rotation. So different sectors have gone through little periods of weakness, but when you put them all together as the overall S&P index, you can see it's just sustained a tremendous uptrend. If you look at the smoothness of the 20-day and the 50-day and the 200-day, they're all lined up perfectly. We've had a number of 2 and 3 day pullbacks along the way, there and here, but nothing really beyond 3 days. Now, at some point, any trend that is doing this has a bigger correction where it doesn't just go down for 2 or 3 days. It might go down and then it bounces and then it might go down again. So I think at some stage we're going to get a pullback in the index that looks a bit more like this, like we saw in October of last year, where we come back closer to the 200-day moving average. So if that were to pull back to somewhere around about the 42.30, 42.50 sort of area, which is another 200 points down, that would sort of make sense. And if that happened in the next 2 weeks, then I think that would clear the way for some terrific buying opportunities. Now, if we look at the individual spreads, so this is the Dow Jones small cap growth divided by small cap value stocks. So what I'm looking at here is not just the large caps. We want to remove the impact of what Microsoft and Amazon and Google and all those stocks are doing and look at the rest of the market. And so this is small cap growth divided by small cap value. And you can see it's been extremely positive for quite a long period of time. So it really started back in 2017 and we had an enormous run where growth outperformed. That peaked out in November of last year when the COVID vaccinations became available and the so-called value stocks that had been left behind for years and had probably been sold off very heavily during the COVID crash, they outperformed for a period. But that all finished in the middle of May, and since then you can see there's a very, very steep and clear move back to small cap growth stocks. This is the Russell 1000 growth versus value. So this is really reflecting the larger stocks. And it's the same story, same time frame. So really no difference whether it's large caps or small caps. And the final one that I want to look at is, so this is consumer discretionary divided by consumer staples. And again, you can see we've had a lengthy consolidation that started at the commencement of 2021, but we're still we're near the top. We're not down and near these lows, so it's a consolidation period. So what that's telling you is that both consumer discretionary and consumer staples are seeing money flows coming into them, but there's certainly nothing bearish about that chart. And then that's the same chart, that's fine. Okay, let's now have a quick look at uranium, because that was the real star last week. And if we pan back, you can see this is the uranium ETF URA. Back in 2011, this was trading up around $130. So that was just before the Japanese tsunami and nuclear disaster. We dropped from 130. We got down to a base around 10 or 11. So it had lost more than 90% of its value. We obviously got a sharp sell-off during the COVID crash, but ignoring that, the base was around about 10 or 11, and you can see we've now clearly moved out of that base. We've come back, we've retested the breakout, but now you can see in the last 2 weeks the surge is enormous, and look at the volume behind it. This is a serious move into uranium. So I don't know what it's going to do in the short term. It's always difficult to start to buy into a sector that's, it's just at the ETF level, it's just moved from around 18, 19 to 26. In the short term, this could pull back. It's impossible to know. But given the dynamics of the uranium industry, I think there's really high probability that we're going to see a sustained move over the next few years, where the uranium price is going to go higher and uranium stocks are going to do extremely well. And remember, the uranium stocks are going to be the same as gold stocks or copper stocks, where the miners are going to amplify whatever gain occurs in the underlying commodity. So, a good rule of thumb in the gold market is if the gold price goes up by X, then the gold stocks typically go up by 3 or 4 times that. And I would expect to see something similar in the uranium space. All right, now let's just look at the US currency. So we look like we were breaking out, turned out to be a false breakout. We've come back into the range, and we're just really bobbing up and down in this range between 91.75 and 93.39. The only positive that I could find out of this is this high is slightly above this high, and this low is slightly above this low. So we are getting higher highs and higher lows, which is the definition of an uptrend, but it's pretty mild. So I'm not expecting anything dramatic in the US dollar at this stage. And if we look at the Australian dollar, it pretty much mirrors it, and we were down last week, having reached a peak of almost 74. We closed at 73, so down a full cent on the week. Turning now to Aussie stocks, so 73.0 was where we finished. Our index was down by 1.6, but one would probably think we're going to see a little bit more of a decline on Monday. But look, it's the small caps that just did incredibly well, and have been now for some weeks. The index itself fell quite sharply, as you'll see, but within that, there are a lot of huge winners. The members' portfolios for my 2 membership services, had an absolutely outstanding week, one of the best weeks of the year. And so at the individual stock level, there's a lot of really good things happening. It spans uranium, it spans all of the battery materials areas, and it spans a whole lot of different market sectors that I'll just collectively call technology disruptors. And it can be in healthcare, can be in industrial, can be in finance. It's pretty much across the board. Even in some retail areas, there's some tremendous winners. So whilst the index didn't look all that pretty on Friday, and we'll take a look at that. So the XSO, it was Thursday, I guess, was the big selling. That's right, and we did get a turnaround on Friday. So the big selling occurred on Thursday, and most stocks fell quite sharply, but across the week, some tremendous winners. Now, if we look at the ASX 200, we've now just moved down below the 50-day on Friday. But if we look at materials clearly having a hard time of it. A lot of that is due to, to the issues around BHP, but also the iron ore price has affected Fortescue and Rio as well. Healthcare is setting new highs now, so we've broken out on healthcare, so it's going along okay. So's finance, but energy is obviously now in downtrend. We're clearly down below the moving averages, and the moving averages have rolled over. So that's the way the Australian market sits at the moment. Turning now to precious metals, gold lost $40 across the week, with a lot of that happening in the last couple of days. So down to 1788. It's all part of a large sideways consolidation at this stage. So the actual gold price, doesn't look too bad. There is a key support level at around 1680. If that breaks, then we could see a much more significant move in gold. But at this stage, the gold chart is not really pointing to that at this point in time. But if we look at precious metal stocks, particularly GDXJ, where it's more obvious, and whilst I use a weight of evidence approach with all of the technical work that I do in the market, there's generally one or two indicators that are really the giveaway. And for me, the one that I focused on most was the chart pattern around GDXJ, as we'll see in a minute. And that was looking quite bearish a couple of weeks ago, which is when I sounded the warning about gold stocks and the possibility of a bigger fall. But then we got a sharp rally, and GDXJ actually broke back above what would have become resistance. But it looks like that was a false move now, in hindsight, and we're now back into downtrend. So the downside case is now firmly back on. If you look at GDXJ and you also look at the ratios, it's pretty clear. So let's look at those couple of charts. So we'll start first of all with, just while I think of it, there is Bitcoin for those interested in Bitcoin. Pretty negative week, but look, at the end of the day, we're still trading at nearly 45,000, so it's not all bad. There's the gold chart on a weekly basis. So you can see that within this period here, so let's say from November to here, is really just an overall consolidation. We've got pretty roughly equal highs here and here, and we've got a lower high here. It's almost formed up a triangle. So within that period of the last 9 to 10 months, you could look at gold and say, well, it's really just going sideways. And you should always trade the market on what it's actually showing you, not what you think it might do. But if we pan back, it gives us a bit more interesting story. We had a very strong uptrending channel, which commenced in 2019. We broke out of the top of the channel in August of 2020, and that formed a new all-time high in the gold price. But since then, you could argue, well, we've actually got a series of lower lows and lower highs. So it depends on the time frame that you look at. For mine, I prefer to look at this as just a sideways consolidation at the moment, because these channels could always be broken out of. But the key line in the sand for me is here at 1680. So if we break these three lows here, which is also the 38.2 Fibonacci retracement from the lows in 2016 to the highs in August of last year. So that's a key level. We've bounced off it 3 times, but if that breaks, then I think you'll see an accelerated move to the downside. But that one for me is still a bit, it's a bit each way. But if we go to GDXJ, because let's face it, most of us do make decisions in the shorter term, and that gold chart was quite a big picture one. But if we look at GDXJ, You can see moving averages clearly rolled over. The price is below both the 200 and the 50. We broke a key support level. We retested it, dropped away. So it all looked pretty bearish. Then we managed to scramble back and for one day closed above it. And the volumes weren't bad either. So that was why I moved to neutral last week. It was the break of this resistance, the break of this little high, and the increased volumes that we saw on the upside caused me to move to neutral. But now you can see we're falling away again, and the volumes are not minor either in the last 2 or 3 sessions. So you've got to say that the trend in GDXJ is down, and if the trend in GDXJ is down, it tends to lead the underlying metal, which suggests that there could be a downtrend about to re-emerge in the gold price. But look, until we break 1680, it's that's the key line in the sand for me. Okay, turning to other commodities, copper was up slightly to $4.31, but nickel really surged up to $9.26. So a big move in nickel, very robust breakout as we'll see. And West Texas crude a little bit higher, getting back up towards the $70 mark again. So there's the spot copper chart. Not a lot has changed in the last few months, but the nickel price you can see has burst through above $9 to a new high. And zeroing in a little bit more, so this is the 30-day nickel spot chart. That one was the 1 year. This is the 30-day, so just zeroing in on the last month, and you can see quite a concerted move in the last month since the 20th of August, from around 8.4 to about 9.25. So quite strong in nickel. So wrapping it all up, the consequences, and this is a discussion that I've had with a number of members and even with some non-members in recent months, where the megatrend stocks have just outperformed so ridiculously well, yet a lot of people feel very nervous about those sort of stocks, whether they're established large cap stocks that are in megatrends, or they're more early stage stocks. They could be in battery materials where they're not yet currently producing, and therefore those stocks tend to be more volatile. And a lot of more conservative investors will tend to shy away from those sort of stocks. But let's look at the consequences of doing that. The first consequence, before I even get to the volatility issue, is that a lot of the traditional, typically defensive kind of stocks are facing headwinds for years and decades to come. Not all of them, but many of them. And so a lot of the traditional stocks that that people would naturally gravitate towards, the names that they know, the big names, the typical portfolio stocks, are going to struggle. They're going to struggle big time. So, right there is a reason for considering other areas of the market. Now, granted, the megatrend stocks, large cap and small cap, because they're high growth and because they have periods where they're significantly in favour and the price gets a bit overblown, the volatility is likely to be higher than some of the defensive stocks. You've got to accept that that's just the case. However, being put off by that volatility without thinking about, well, what is the alternative, is, in my opinion, not the right way to go. Because the reliability of that growth, if you select wisely, the reliability of that growth in these megatrend stocks is a massive advantage. It's huge. The probability that these stocks, the businesses are going to grow and the share prices are going to move higher over time is far, far higher than a lot of the defensive areas of the market. The second thing is that the overall return is likely to be significantly higher and therefore another massive advantage. So the question for me is not shunning the volatility, but it's looking at fine-tuning your game plan to compensate for that. There are many things that you can do in the way that you enter and the way that you manage those stocks and the way that you select those stocks that can compensate for that volatility. So you can still access the huge upside and the probability of that upside, but you can manage the volatility to a better extent. And that's largely, what I covered in the building a portfolio, a more effective portfolio video, which was released last week. That was what I was trying to capture there. That there are things that you can do that allow you to, I guess, to get the best of both worlds. You can get the access to the better returns and the higher probability, and you can learn to deal with the volatility that goes with that. So for anyone that hasn't had a look at that, I think it's well worthwhile. It's a very nominal sum of money, and I think you get enormous benefit out of it. Overall, it's better to be a bit early than too late. Now, uranium is a sector that I've been promoting to members for 2.5, 3 years. As it turned out, I was far too early, but there were a lot of other very knowledgeable people that were far too early on uranium as well. It just seemed inexplicable how long it took to get going. But the point is now that it is going, and we've had positions in uranium stocks both in Australia and in America, and those are really starting to pay off. And this is not a recommendation, but just an observation. We've been in an Australian stock called Boss Energy. We got in at around 8.5 cents. It's now trading at 26. So the payoff has come through in spades, and it's better to get in a little bit early on some of these, build some positions. We got into Vulcan Minerals, for instance, in the battery materials space, which is a pretty popular stock these days. We got in at just over $1. Now it's trading at $16. So there's fantastic opportunities out there. It's a matter of building the portfolio in a way that suits your overall investing style. Portfolio analyst last week, we did look extensively at the uranium sector, looked at the fundamentals, and we looked at a number of stocks from a technical perspective, and also dealt with some game plan issues around uranium as well. So I think members found that very beneficial. We looked at several aspects of technical analysis on stocks in general, and also went through and reviewed a number of recently recommended stocks that have done quite well. So that's it for this week. If you would like more information, there's my website and email address, and there is a link to the portfolio construction video just below this particular video. And I certainly would, if you haven't purchased it and had a look at it yet, then I'd certainly commend it to you. That's it for this week. I'll be back with you next weekend. Cheers.